of family offices and direct investing and what they like to look at. Sal's got many years of experience, although he looks like he's 20, right? He's got many years of experience on Wall Street, in the financial services and real estate, entrepreneur and financial manager through and through. So, Sal, why don't you introduce yourself, and then we'll get into Q&A. I've also got Natalie McVeigh on, and she'll introduce herself after Sal.
Okay, hey. My name is Sal Buscemi. I've been working under the moniker Dandrew Partners for the past 20 years. We started out doing real estate deals after I left Goldman Sachs in the investment banking division. And at the age of 29, just real quick, I raised during the financial crisis, or right before, from a Park Avenue investment manager, $30 million. And that was me as an emerging manager, so I was off on my own. And we basically became the kitchen sink for Bear Stearns, buying a lot of the whole loans. And then during that time, we also saw a lot of opportunities in distressed real estate, specifically in more of like the riskier areas of business called hard money loans or bridge loans. And Irvine, California was the capital for that, if you remember, in 2009. And so we had another institutional investor who gave my partner and I, who's actually my general counsel still to this day, Fred Wade, a equity facility where we were buying a lot of these assets that people had overvalued or actually overpaid for, using a Dutch auction technique to be able to buy these fractionalized interests. And what we do is we would just cobble it together and then sell it off, and it worked really well. In 2013, though, I started working more with family offices, and I wouldn't say it was that at that point, but I was thinking about this last night at dinner. I've been following Marty around now, like the Grateful Dead, for about 15 years. And
Willie Nelson.
No, really, I'll be honest with you. And we've created, a lot of people, I see there's like a younger generation coming in, but there's a lot of success we've had. We've had great relationships. We've invested in the father of venture capital, Fred Nasm.
There you go.
The Brahmin himself, Alan Snyder. You're laughing. My spirit animal, do you want to guess who that is?
Your spirit? No.
David Robb.
David Robb. Yeah, he's a good guy.
All right. And I think Marty runs a good filter. He runs a tight shop here, and I think we've had a lot of success. And I'm not, anyone who has any questions about that, I owe a tremendous amount of my success to Marty outside of real estate for a lot of these conferences and being able to build a world-class, not only smaller balanced venture fund, but a multifamily office too. And for that, we should probably give Marty a round of applause for that, but we'll do that afterwards. Well, yeah, give it now. Come on.
Please.
Sure. So that's right now we make direct investments only using a platform based. It's a Nevada Series LLC, Master Series LLC structure. We make direct investments, and we set up this family office structure because of speed. We wanted to be able to get into things because a lot of the deal sourcing that comes to us are from relationships that go back at least 20 years, me going back to Goldman or my partners going back to their respective industries. And what they value is the ability to move fast, especially if there's a larger lead in front of us when we're able to move. And one of our CEOs who we're very proud of actually sitting in the room right here, Chris Apfel, I don't want to draw too much attention to you, but he's a perfect idea of what we call a pedigreed, very experienced entrepreneur who we like to, the type of people we like to fund in that capacity.
So I don't want to get too far into it. Yes. I want to introduce Natalie. So
sure.
Natalie, can you give us your background, introduce yourself, and talk about what you do at Eisner?
Hi, I'm Natalie McVeigh. I'm a managing director in our Center for Family Business Excellence at Eisner Advisors. We're doing this for 15 years, so I'm less on the numbers side and more on the thought process side around the families investing, working with family offices, private equity and VC around their decision making, how families are involved in this process, and how they partner with their co-stewards who do some of the investing, and to prepare that next generation to be able to be on the boards, etc.
Fantastic, great. So I'm going to ask a couple of questions, and so obviously there's a lot of changes. We were talking about economy the last 2 days, some fantastic data, but we don't have a lot of data on private markets. And I was, Sal, since you're like knee deep into stuff, I was hoping to get some kind of background on where you see the private markets, and I was hoping Natalie could jump in and especially from what you're looking at right now, since you do a lot of private deals.
Yeah, so I'll bifurcate that with venture and then real estate. Real estate, we have one deal that we're very proud of. It's the Class A that we joint ventured with a family in Southern California. 166,000 square feet. That's the last deal we're going to be doing for a while because a lot of the families are starting to see that, look, there's going to be opportunities coming in real estate. So they're switching from like that core focus to where they get that, that statement asset, that everybody wants, Amazon, whatever, to something like, hey, hold on, there's going to be a pullback, we're going to be more basis driven, and they follow our leadership into that. Regarding the venture deals, the CEOs are the ones who we work with and are mostly pedigreed themselves. There's no really capital shortage. They either self-funded or they have families that are leading it, so there's a lot of depth. But that's not to say that there couldn't be any changes in valuations. And right now, the families are still supporting a lot of these venture funds because they see it, especially in some of their companies, that they see the industry agnostic, they see that it's their job to sort of step in and be the opportunist when the institutions who are sort of like monolithic utilities all of a sudden start to pull back. So they're started seeing their job more as a traditional merchant banker coming in a time of distress, being able to provide not just the strategic, but also the capital and the reputational capital as
So
well.
are you saying that on real estate there's a pullback and people are waiting for kind of distress to start popping up?
There is, yes, because the general sentiment is that fools rushed in and rates were very, very low, and it was almost unsustainable how this could happen until you started seeing rates move, and ostensibly the Fed wants to move rates higher, they have to, and I think that's going to destroy it, and it's going to cause a lot of equity impairments, and people are worried about that. Coming out of the pandemic, you've had people who had equity impairments because they couldn't collect because of COVID rules on rent. So you had a lot of changes. So people right now are saying, okay, we're going to move into other asset classes, but we're going to see what happens first, put our pens down, wait a year, because it's only going to get better depending on your view of the world, and a lot of them are, pessimists surrounded by risks.
And how do you compare it to 2008, 2009? I mean, I know you're a veteran of that period and you understand like the economics and, like in 2009, 2010, I think somebody sent me a package for all the trophy hotels in Miami Beach, south of 42nd Street in Collins. So like the Fountain Blue, the Eden Rock, everything was like 30 to 50% of what the 12-month price before had been.
Yeah.
Are we, reliving that or?
I don't know. Here's a question. It's for macroeconomically speaking, and again, I'm just a financial nerd. I'm not a credentialed economist by any means. The U.S. is still a very safe place for people to invest, and you have a lot of foreign capital that's still coming in that's sort of balancing the issues right now, or offsetting, maybe the equity impairments perceived to be, while they're chasing assets and they're still able to maybe pay a premium for that because they have different capital sources from overseas. Let's face it, have different needs, right?
So there's rule of law. It's like least worst market.
Yes, exactly. So but they're still gravitating towards the top markets and the top assets. But I think if you look at real estate as a whole, it's a concentric circle, right? So the further you're out in that circle, the more that the stress is going to be. But the closer you come to Manhattan, you're not going to see a skyscraper change hands for $1 yet, right? So it's a function of the market, but it's also a function of outside capital that wasn't there 12 years ago that's coming into the market and moving things.
Some families in Manhattan have owned buildings for 100 years.
Right.
Right. So, and we also know, so you had talked about, you looked at some trophy assets. We know for a fact that a lot of foreign money will come in for trophy assets. So we saw, I guess when Uber was going public, for example, people were willing to buy in at a premium knowing that it was going to probably decline after going public, but they still wanted to say they were in on it before.
This opens up a whole can of worms that you and I have talked about before, and a lot of the families who gravitate towards us are second gens who are not financially sophisticated. You would not find them at a Marty Secada event. They send guys like me here. What they're looking for is their own legitimacy in their own right, or the next stop for that legitimacy. And the way we look at it is we're merchants of legitimacy with a lot of the deals that we lead. And I started this by leading with my own checkbook, but really what these families want is they're like anyone else. They want to be able to talk about their investments. They want to be able to show off that my CEO is better than your CEO, and all of this, because that really is what they understand at a visceral level. And what we talk about is some of the deals that we'll get into, but a lot of these people gravitate towards these assets because they see it as being a significance not just of themselves, but of the wealth and the influence that they are perceived to have.
Natalie, could you jump in and tell us where you see the market right now, the families that you're counseling, and where are they pulling back? Are they reassessing? Are they looking for opportunities? What do you see happening?
I agree with almost everything that was already said. Most of my clients are high net worth, so they have the money regardless of what's going on. And many of them that started their family office or their VC firm or their PE firm had an operating business at one point in time. So they're really looking for other successful, often privately held family companies so that they can really spend time on a board, right? They already had their exit event, realize that being out of the entrepreneurial game is not as exciting for them. And so they're trying to be either an owner's council, a board of directors, and help other people get into the day-to-day management. So they're feeling involved, feeling engaged, and yet able to reap the rewards of the success that they have right now.
It's part of their identity. It's exactly what Natalie said.
Maybe you can talk about, Sal talks about credibility, but what about legacy?
Yeah, so that's legacy for our clients. The legacy in family companies now is not holding on a landmark business. There's some research that talks about entrepreneurs in every generation. And so how do we allow our families to be entrepreneurs and not necessarily have to do the piece? So just like Sal mentioned about this idea that they might not be as sophisticated. Some are. I have several clients that are their CIOs in their own family office, but others are more interested in philanthropic endeavors. And that's where we really work with our clients to create, their investing strategic guiding principles that work for an operating company that still exists, for their investments, and for their philanthropy, so that they're really going in one strategic direction, even if they have to farm out pieces from someone else, that they can still do the oversight and make sure their wealth is working for them.
Didn't somebody coin the phrase entrepreneurial philanthropy once a while back or something like that?
Absolutely. And I think the really big piece for them is understanding the oversight that they have and making sure that they can create a continued legacy that speaks for themselves. You used to see, you'd be in oil and gas, but then you'd be giving your money to reforestation. So now we're trying to find a united way that these clients can do this and pursue what they enjoy.
Sal, any thoughts on that?
Yeah, I would continue in saying that in action that looks like interactivity, and interactivity is a new currency. And the CEO of two family offices, I could say one of the metrics I look at is not the deals or anything, is the open rate of the emails, the interactivity, the reply. How am I penetrating these people's attention, getting on top of it? We spend a disproportionate amount of time doing that because we want to build a community. They want to be a part of a community.
Yeah, and one of the things we help family offices do is we train their staff to create reports that are bite-sized, meaningful, quick, because our clients aren't as financially sophisticated. And before it becomes problematic, we want to ensure that everyone's on the same page and that it's meaningful, right? When there was a downturn, and there was, and there may still be more, it could be negligible compared to the total end. And that's really helpful for them to understand.
So the last 3 years have really been a whirlwind. I mean, it's hard to remember because we've got $5 gas, or actually in California, $7 gas. But it's hard to remember that, the economy was booming 3 years ago, then we got hit by COVID, right? And they're kind of coming out of that. And then you have this whole major reassessment. Russia has made a move. There's some thoughts about China making a move. And so what does a post-pandemic modern multifamily office look at today? And how do they operate their businesses, et cetera? Sal?
They are looking at it from the standpoint, the assets that these people are looking for, really, nobody complains about overpaying for. So it's fine art and European sports teams, right? So they're looking at it more and going into a defensive mode, because where else can you get that type of return? So that's not a function of that sort of maybe is a harbinger of what we're looking at, but they're looking at things that sort of are more durational, not so much from the standpoint of looking at the equity indices every day, wondering what's going to happen. I think with them, they're looking more forward as just being custodians of value and holding on to that value as much as possible.
And actually, those are great rewards, the sports teams. Although I guess a couple of them have gone up for sale with the Russians selling them, right? So
there's opportunity, right? And, when oligarchs are selling, people are buying. So
there you go. Natalie, any thoughts on that?
I agree. It's really about creating value, making the money work for you. And the one difference I'd mention is that because of COVID, because of the war, there's this focus on ensuring that families are being supported. So when you had these traditional investment family offices, you might not have had the concierge piece. You might not have had the part in which the human capital of the families developed. And that's been something that we've seen an investment over tenfold in right here is, we have the money, it's secure, we want to keep it secure here on out. Now, how do we ensure that our people have the time to enjoy it, feel like they can get around it? I have clients that moved to the Dominican Republic and bought the family compound they never thought that they would have. So there's this return to some real estate, but more personal, right, for the family to gather around.
Right, so yeah, I guess I understand that a lot of people have moved to Puerto Rico, and here in California, I can count a dozen crypto guys I know, so that's obviously an approach. But so let me ask you a question that's kind of totally off the cuff. Do you think that the recent paint throwing at the Mona Lisa is leading people to rethink their art collectible approach?
Yes, and DE&I has to do with a lot of that as well. Some of these things that we have, these collectibles have provenance questions. There's a lot that's going on. So the more that we look at impact investing, the more that we start looking at transparency and intentionality, some of these items we need to rethink about how we're looking at it. And that's a lot of the time that we're working with families as well, is they want to make sure they're not accidentally stepping into something that could be problematic, as well as not denying what they like. So there's a balance here.
I think some of these collectibles actually have symbolic meaning to different audiences, and so maybe they're anarchist types, and the people at the Louvre who threw the paint at the Mona Lisa, it's one of those things, and so I'm wondering if people are saying, well, if I own this, so there used to be something called headline risk among family offices. I think it still exists.
Oh, it does.
Right, where you don't want to be exposed to being an investor in something that is socially not good. And I'm wondering if family offices are reconsidering the visibility of what they're investing in. Maybe there's more private transactions. They want to keep secrecy. So maybe you both can talk about that. Maybe people want to go through intermediaries to acquire some of these collectible assets, etc. Any thoughts on that, Sal?
I do, yeah. I mean, there's different ways to play it. I think if you're looking for that clandestineness, then we prefer being a private credit lender through our friend Alan Snyder. I mean, it's a real estate. People are like, "What are you doing in real estate?" I'm like, "We're not doing anything for at least a year. Give it to Alan because he's paying a solid 6, 7, and you can basically put a clock to him." The families, though, when they look at other hard assets like art, that's sort of more esoteric, because Steve Wynn put his wrist, I think, through one of his paintings, and it actually increased in value because Stevie Cohen bought it from him. So, it's still a store of value. It has been for longer than this country's been around. It survived the bubonic plague, but it's the status now that everybody wants in a very conspicuous society to say that I own this. Not everybody does, but some of them do.
Yep.
Sort of like sports team owners, right? Some of them want the glory. Some of them want to say, hey, I'm networking with the best and brightest and possibly most qualified list, of people out there. But, there's also charitable foundations which just exist to give away money, and they don't really care. So its beauty's in the eye of the beholder with art, but it has a 600-year provenance so far that nobody's really been able to shake a stick at.
So something, and again, this is kind of an offline comment, but I like to think about things as value increases when there's platformization. Like if you look at people who invest in platforms, Facebook, Google, blah, 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 Tom Farb's stuff, great platform.
Yes.
Right, and so where people are looking for platforms, and what you're seeing when it comes to sports is that because of social media, there's this massive expansion of sports becoming like a platform. And there's been legislation passed where now college athletes can put out their own NFTs. They get ownership rights to their images, things like that. And so as things become platforms, they become more valuable.
They do, because you have more people and more entrants into the market. So you have more of these emerging teams that are coming now. That means more revenue, more teams, more betting revenue, right? More of everything, and you're channeling other streams of revenue that were never really possibly able to capture before up until now.
Right. So it's more, how do I make money? You see that there's lots of ways to play sporting. Natalie, any thoughts about that? I mean, are you seeing people kind of accelerate as they see things become more like platforms, and this is something I really want to take a look at, take a deep dive?
I see a bimodal distribution, right? There are a lot of people who are interested in platforms, the distribution of that, and there's a lot of competition. And I also have clients on the other end, to Sal's point around the status symbol piece, where it's private, it's mine, that's what I want. I don't actually want to play in the big pool, right? And so it depends on what you're looking for. The next generation, in my experience, are more excited for these platforms. The previous generation is more, trying to figure out old money, legacy, this is how I built it, let's keep that. And ideally, it's trying to find the balance between the two.
I mean, financialization today means fractionalization, doesn't it?
So I mean, that's one of my pet bugaboos is that once you start tokenizing real estate, why would I buy real estate assets in Eastern Europe when I can invest in a token of a skyscraper in New York, which I know the value will be preserved forever, right? So tokenization leads to some sort of liquidity that people are able to take advantage of. So fractionalization, tokenization, I look at them as being very similar. They're different sides of the same coin. So, and Natalie, do you see any kind of movement towards that as well, where people are looking at their real estate or other hard assets, looking at fractionalization?
Real estate and even sports teams, actually. A lot of these clients, they have someone as the face of the sports team and maybe they're fractional owners in it. And so it's a way, I think Sal said in the beginning, we were talking about status, but there's also this belonging piece. And so that's how you curate who you're with and how you're with them.
Right, I think maybe it was the Minnesota Timberwolves or somebody like that was sold recently, and it's always kind of inherent that they bring in like diversity in their ownership group and more inclusive and.
Sure, I mean it's definitely still difficult to get into. I mean there's some owners that I talk about in my book Investing Legacy. It's like the embarrassment of New York City Co-op board to know why you're rejected with the whole world knowing, right? And so even if you have anything even the least bit salacious next to your name on a Google search, that's enough right now, especially in today's society, to keep you out from being an owner. So it's even more of an exclusive club. Think about it. Rush Limbaugh never owned a team. Jay-Z owns what, right? So I mean, there's a lot of legitimacy there for a lot of these families because for them that's the next ceiling, to punch through at the next level.
Can you guys talk about deal flow? And again, I'm not sure if Eisner Amper gets involved in that side of the deal process, but to me, the hardest thing in the world today is to find proprietary deal flow that's good. So, Sal, you want to address that?
Yeah. My rule on proprietary deal flow is that we have a very strong deal pipeline to the point that we actually had to, during the pandemic, create a structure to be able to accommodate that. And the deal flow comes to us basically on a reputation basis. I mean, these are people people I know. And there's usually a fuse to it. And the reason is because somebody was coming up right until the point, and in order for this institution to come in, or a family office, for example, we need to be able to show $500 or $1 million. And so the magic sauce that we've been able to do is to be able to raise in a short period of time, a massive amount of money for these companies, due to the fact that they have a tremendous story and people want to be a part of that legacy going forward. But that also leaves opportunities too for them to be able to enter into opportunities that they would never think of getting into in the first place, being real estate investors, right? So.
Yep. And I think it differs by sector and industry. For example, we've had people come on who are VCs and say, we won't invest in anybody over 30.
Yeah,
right?
I mean
when it comes to tech.
But
however,
the families are very, very topsy-turvy. They're very opportunistic as long as they understand the story and the risk, right? It's not difficult for me to say, hey, this is a guy that is a Nobel Prize winner in oncology for 2018, and a company, Linda Chin's one of our CEOs, and say, we are the Emerson Collective, which is, I'll just put out there, Steve Jobs' wife's widow's family office, and the Tito family, vodka family, led this investment. In order for Tito's to come in, we have to show $500,000. We were able to do that, but we also get higher multiples on invested capital earlier on too by being very opportunistic but very agile. And that deal flow comes from my partners, who have great reputations of basically funding deals in real estate, myself too, just being that person taking care of some of the hard work in that business, especially in distress.
Right, and I think one of the issues is that there might be some misinformation in the media about how venture capital is done. But we found a lot of great success in looking at multi-time entrepreneurs in the healthcare space, for example, because they tend to, because healthcare is so complex that you really need to understand the economics and the regulatory environment and where things come from. And so in that way, some gray hair actually is very useful. So Natalie, any thoughts on that?
Very similar. Once you're at a certain place, it is who you know, how you know them, getting in front of them. But I think the deal flow challenge is really when you're starting your family office. office more than anything. And there are some family office forums that work really well that help create that so that you actually get to start joining in other people in these deals, vetting them together. So there's the two sides there.
And unlike VC firms or private equity firms, family offices don't have to be on a clock, right? They don't have any,
No duration. They're not going to be like, all right, we'll hold you for 10 and then maybe another like extension too.
There's no duration risk.
No,
right?
they're looking long term. Actually, some of the families say, Sal, don't invest in anything don't expect us to invest in anything with you that doesn't have at least a 40-year, doesn't meet their 40-year impact plan or impact statement.
But some of the best investments you never sell.
Yeah, you don't.
Right? I mean, that's like it's a well-known approach in real estate.
Oh,
As
sure.
I said, there's families who they buy the real estate and then they finance the other shareholders out, and
Yeah. It's been going on like that since beginning of time.
We have a question from the audience.
Yeah, how open are you for deal flow outside of US? And if you're not, then what are the reasons? I understand most of family offices in the US are more US focused, but just to help me to understand what are the implications that you have in mind when looking at deal flow.
What do you mean? Do we do any outside investing overseas?
So the question is, how
Cross-border?
amenable are family offices to non-U.S. investing if they're domestic U.S.?
They are. So I'll let the cat out of the bag. We're looking at one opportunity here, which is AI in sports. The company already has Chelsea Football Club and several others as their clients. The families that invest in this with us get jerseys with their names on it signed by Chelsea Football Club players. So this is going to go well. Is that going to go over well at UK? Yeah, we'll probably have to hire K&L or Perkins Coie, who we use, to see what that cross-border transaction looks like. But they are very open to it because they're sophisticated enough to understand it, and if they're not, they're sophisticated enough to ask questions. And we don't get anywhere near that unless we are couched in with legacy owners who have been through this before and operators that have had many exits or done this in respect to staying in their lane for these types of things.
Yeah, I think there's some regulatory complexities. My only remark is that, and I'm a young guy like Sal, a little bit older, but the issue is that foreigners do so well in the United States.
It's why, yeah.
So it's almost like, why tempt ourselves by going to an area that isn't as, number one, rule of law, right? And number two, regulatory aspects where you don't know who is influencing, pushing, the environment, et cetera. So I ran a very large group at JP Morgan back in the day, and we did a lot of work with Indian and Philippine and Costa Rican companies, and we demanded that they have assets in the United States equal to the amount of work we're doing with them, so that we could sue them if something went awry.
Yeah.
Right. So I think that's.
Yeah. I mean, the U.S. It's an easy sell for someone overseas because the U.S. is a safe place to invest. Where else are you going to invest today?
But what about the venture capital and private equity funds outside of US?
What's come out of that area so far that's going to attract a lot of interest there?
And all Europe is catching up with the US, like the number of unicorns popping up like really fast. So there is more emerging possibilities, I think, in certain areas than the others. And
It is.
in the US,
I would think that Europe is probably fantastic when it comes to privacy, and there's still a regulatory framework that has to be understood, right? There's no doubt there's a lot of venture capital that's happening in Europe right now.
But I can tell on experience, just going through we did one deal with the Shimano family office before Aviva bought Singapore Life or merged with them, and I can tell you that the reticence is that there's perceived to be a legal expense associated with doing something that might not in the end come to fruition because you don't know who the actors are. There's a guy from Hong Kong nobody's heard of, and this is the type of stuff that turns a lot of people off, and that's why they're attracted to guys like Tom or Chris. That's what they attract for, and it's also a function of their ego. They're not thinking logically like, oh, there's probably better returns in Eastern Europe. They don't care. They care about outdoing their friends.
Yeah, I think that recourse really matters, tremendously, and also being able to get what's what I'm looking for, like full disclosure, who the person
Control.
is. Can I investigate? And I'll tell you, so I was early into the crypto craze. I got approached by somebody who I've known for years. I think he's like a Yale guy. He said, hey, why don't you come and get on the board of directors of this Canadian crypto company, right? So I go and I talk to the guy over breakfast, the guy who's heading it up, and there's a guy on the side who's like actually answering and asking all the questions, right? So I said, look, sounds really great. Can you do me a favor and send all your bios and let me know how I can, Google you and find out information about? And they disappeared off of my chart entirely. And then 2 years later in the Wall Street Journal, they're revealed as being a huge fraud. And the guy had changed his name. He had been arrested for being a securities fraud in Canada, et cetera. So, right, in Canada, right? So I got another phone call from a guy. So the guy's name was like Mike Johnson out of Australia, deep Russian accent. Right, so I mean, all kinds of stuff.
Nobody wants that. I'm gonna get on the phone. Hey, meet Mike Johnson, and he sounds like Roman Abramovich.
Exactly,
right.
Nobody
it just sounds.
This is coming from a very digital society. All the information is.
Yeah, but you're transactional.
Like there's nothing is hidden. Like all the.
You're transactional.
So you're saying that if I look at somebody from Eastern Europe, I can find out everything about them?
No, not in every country.
Getting past Cyrillic, right?
All the shareholders of the company, like all the connections, all the previous financial year reports, everything is public, everything is accessible online.
So can I ask, since Natalie works for Eisner Amper, which is an international accounting firm, right? Maybe Natalie can talk about like the price of doing due diligence in multinational environments. Natalie, any thoughts?
I'm not an accountant. I'm a consultant. I used to work in a bank as well, and this was one of the pieces. Like it takes a lot longer, it can be more challenging. I have clients that do both though, but again, it depends on who they know. So these are families who know each other. A lot of my clients have multinational companies before they had a family office. It's not that they don't do business outside the United States, but they definitely do it with known quantities. Again, mostly Western Europe. Not exclusively, but that's what happens most of the time.
Let me explain to you the difference, and you use this word, and it epitomizes everything. You said digital, right? We're digitally advanced. Families only move money when they have a strong relation with you. They're not going to just do a deal in Croatia because everything works well and everything. There has to be strong leadership and strong ties to families that have worked together, have known each other, because a partnership is a marriage, really. Let's face it, right? So that's what they're looking for, is the more relational standpoint, not the transactional standpoint where here's a deal, write a check, and then move on.
I think you need to take a step back and say, and again, Sal's the expert, but families do look at relationships for those sorts of families, but at the same time, most family offices only go into investments as co-investors, right? They're almost never the lead investor, so then they have to say, do I actually trust this lead investor?
Mike Johnson from Russia.
That's my experience over the years running family offices is the family looks to you.
Paul, yes.
You have to talk to my guy, or my gal. You have to talk to them. It's a deflection because they know they can't do it, and people come to them because they're rich. And
but they don't know what they don't know.
So
they're never going to tell you that.
So Paul Perez, who ran Perez Asset Management for years, is talking. Just so the audience online knows, is that historically, it's a big ask of family offices to look at certain people unless they talk to the other person who's supposed to okay them, and that other person really is going to look at relationships. Everything can look good. As a matter of fact, in the digital world, it's easier to make things look fantastic.
It's the metaverse. That's the whole reason why the metaverse exists. It's for everybody to look better than they do in real life.
There you go. Right. And so like a great example, and it's kind of off in the private world, is that if you look at hedge funds, there's pretty much like one or two ways to look at hedge funds. But when they approach you, they'll give you 50 ways, whichever way is the one that makes them look most advantageous, right? And so you have to say, great. Well, I get the same thing from ventures and other people. So you need some kind of an intermediary or a traffic cop or somebody who's saying, great, this is the way they want to look at it, and this is really 9 times out of 10 the only way you're going to get by. Well,
there's relationships and relationships. Sometimes they have a relationship and they know that they don't want to invest. So once again, you have to talk to my guy or my gal.
Yeah.
Oh damn, he said no.
Oh, he's in Bahamas this week. Oh, right. Like we don't check email anymore, right? Honestly.
One of the greatest metrics out there is that they've done studies of people who introduce the best deals, and without failure, they tend to go back to the mean pretty quickly because they're finally opening up like a pipeline to be able to just shoot every deal they know.
Let me give an example, and this goes back to Marty. So Marty and I have a friend in common who's one of my partners, and Marty knew that I was like a gunslinger, and I already invested in Fred Nassim and a few other deals. And he sent this guy out to Las Vegas. This guy, I don't know how that conversation went, but you have this guy that has 3 Ivy League degrees. He's like, go out and meet this crazy guy in Vegas, Sal. He went out there for riches and distress, and he does real estate, but he's done healthcare. That was when we invested in Unicom. I invested personally in that in 2016. The valuation on that was $15 million. Today, it's about, and again, maybe just looking for an accounting for like a downward index because of the markets, at around $375 million. So there's a huge multiple there. So it's the relationships that I have. So it's all relational. That guy would never have gone on a flight to have a layover before going anywhere else he was going to talk to someone else if he did not get referred to me by Marty, who knew me at that point probably by at least 10 years. Does that make sense?
And one of the great stories about Immunicon is that the founder was a guy with a PhD or he's a doctor.
Yeah.
And he's got tons of gray hair. He's been through like, several, startups, etc. And it took him years to raise the capital.
It did.
Whereas his son had just graduated from college with 2 MIT guys, and they raised $15 million in about 30 days.
And then after that, it was Google Ventures that put in like another 30. I mean, they just, that
and again, it's the schism for under 30 versus over 30 in terms of investing. So.
But it's true, but it's all relational, and I would not have been comfortable writing that check,
Natalie, any thoughts on this in terms of like, relationships and, when people ask you to look at things or for more information or, best practices?
Absolutely, it starts with relationships, and then there's usually a due diligence team that kicks things to the curb. And there's also the family's legacy piece. You mentioned that earlier. So if you are a family that's been in sports, you might want to have things in your portfolio that are more towards that, or gas, etc. So it's not every deal, and it's not everyone you know. It really is if it fits your legacy, if it fits your vision, if it is people you know, and then making sure that it's safe. I think Sal was 100% right. They're not looking at small deals. Most aren't doing less than 15 years. And many want to invest in other family entities as well, because they like having that circular economy they were a part of.
Yeah, I think what's most intriguing, it's one of the questions that Sal had asked about deal sourcing, is that there's this mass proliferation of accelerators and incubators, et cetera, and all they do is help people prep for how to raise money. But so you're always today you will most of the time get documents from people that look pretty good, but then you have to ask them the business questions, right? Any seed investment looks pretty good as like a generic, hey, this could be great. I mean, actually,
area code, yeah.
Robert Levin and I came up with the most Robert, can I reveal what your idea was?
Only 300 people. Yeah, it's a trade secret. Go
No,
ahead.
I don't want to give it away. It's actually, he's going to make so much money from this idea.
We'll talk afterwards.
It's ridiculous. But I mean, the reality is that you have to look at the economics and how to make it work and whether the person who's doing it is seasoned enough to take you there.
I love people who have had multiple exits, right? We're in one deal right now. The guy's had 69 exits. He's a little slower on the next one, but I also know he's not going to die until he sells it. That's the grit I look for, because all risk is human. And if you had, like, for another guy that we're talking about, many exits under their belt doing this, because it shows that the grit, the determination, the network, and the respect to know what's going on. And that doctor we were talking about actually worked at Cardinal on the buy-side acquisition, so he knows the other side's playbook. Families love that. They understand it. If we were starting to go into the science, eyes will glaze over. That'll happen later.
So, I was talking to one of Sal's persons that he invested in, Fred Nassim. Fred has taken 70 companies public, 60 have had, $1 billion valuation, et cetera. It's a tremendous success. And I was having lunch with Fred, it must have been like 7-8 years ago. And I was talking to him, he says, Marty, at this point in my life, he's over 70. He said, at this point in my life, I'm not interested in singles or doubles. I just want home runs. And if
Elephant hunter. He calls himself the elephant hunter.
Exactly, right.
Yeah.
So Sal, I was hoping that maybe you could address, there are statement assets and there are like statement entrepreneurs, operations, like guys who have done it over and over again. They said, this is it, I'm going for,
I think
100-yard dash, past the finish line, etc. Can you talk about that a little bit?
Yeah, I think a lot of the families, and this is something that's gone back to like merchant times, is that you have a great exit, and what do you do next, right? So your relationship is already stressed with your wife. So you're like, do I get to know her again? Wait, I don't know. Do I go into another business and start over from scratch? But what they really want to do is to learn how to invest. And in order to get them to do that, you have to be able to have real meaningful deal flow into things that they would really like. And we've done this for years with Class A real estate, but now it's turned around to be statement assets are not just maybe, a football team or, fine art credit or real estate, but it's also maybe being involved in a deal where there's a Rockefeller that's leading the deal, or, or Estee Lauder, like in Tom's case or something. That's what they really like, is that provenance, and that really shows the conviction that, hey, I'm following other smart money here. I'm not going to get screwed. This is not like my brother-in-law who's a crypto bro.
So let's talk about entree to family offices. So Natalie, and again, Eisner has had stunning growth. When we worked with Eisner back in the 2000s, right? Eisner was a 300, 400 person accounting firm based primarily in New York City. After several mergers, I've been told they have almost 2,000 accountants now, and they're in 10 different countries, and they've got associations of international law groups, etc. So Natalie, does Eisner deploy this massive network to get more entree with multinational style clients and into those family offices, who many family offices are multinational today? So you can talk a little about that, and Sal can talk about how to get entree as well.
Yeah.
We do have some family office forums. We also have a CEO, CFO forums, and a CIO forum. I think that's what clients are looking for. They're looking for places where they can trust each other, get to know each other, and do these deals, as well as understand how each one thinks about this differently. You've heard the phrase, when you've seen one family office, you've seen one family office. So just because Bob does it, and I golf with Bob, doesn't mean he's the only one. So when you get to these peer groups, one, you get to learn from experts. They can help you get the guardrails. And two, you really get to understand how other people are thinking about their assets. Because you can make it any way you want it to be. I've been surprised and dumbfounded at times at the different ways my clients have decided to do their work to increase the value of what they've already created. That is quite immense.
Your thoughts, Sal? How do you get entree into this, almost clandestine world, right?
You gotta not be afraid to write a check. That's it. You do. Because nobody's gonna take you seriously until you write a check. I was seeding all of these deals before I started putting together a fund or SPVs because I wanted to show conviction. What shows more conviction? A pretty pitch book, a pretty back office, or writing a check and forging a relationship with the CEO?
Shared risk.
Shared risk, yeah. It's sort of like, you get hurt, I get hurt.
Alignment of interest, et cetera. So
yeah,
that's fascinating. So I know we talked a little bit about real estate, but maybe you can take a deeper dive into that, Sal. I mean, you said there might be some opportunities in the future. Any geographies or any sectors that you see? Like, for example, we had Peter Lewis on from Morton Equities, and he had sold a bunch of warehouses to Amazon during COVID, and now Amazon's trying to get rid of them, and right? They overcapacity. Any thoughts on that?
Yeah, I think everything's going to be cyclical. I mean, obviously we have industrial interests in Las Vegas. It's 100% leased. We're not really exposed to Amazon. But I think right now that in certain asset classes, if you were to look at commercial real estate and bifurcate it, it's between, the people who invest with us are the ones who go into, like, say, Class A office or Class A industrial. Then you have the other who are more wealth creators, and they use residential to do that because they're taking the risk of the residential tenants, right? You're taking on tenant risk, and you buy a value add, you turn it from Class B to a Class A or a Class C to Class A. Today, though, what's happening is that I think a lot of people rushed in and they bought too late. Capital structures were just there. You could get the last dollar for free. I mean, you can invest $1,000 and own a $10 million apartment complex because the capital structure was just layered, like a stack of IHOP pancakes, really. So when that money clears out, there's going to be a lot of equity impairments. And what I've done, and starting, since I left Goldman Sachs, was putting together these programmatic equity facilities where it would be dedicated to one operator or one sponsor, like we've done before, so that we know when things are coming down, this is the way that we play. We'll allocate that equity accordingly, doing that into opportunistic situations. We haven't seen any yet, but we have our feelers out.
And 1 second. So Natalie, any thoughts on that? I mean, obviously most family offices have substantial real estate holdings. a plurality of family offices out there, or real estate family offices. Any, thoughts, guidance that you have?
I think the thing about the real estate is really helping families understand that real estate is a different investment. They might need capital expenditures. I think the financial literacy around that is really important. And we're seeing, there's a lot of interest in REITs and different ways of moving the real estate.
I think we had a question from the audience.
Yes.
I was curious of your view, because I know the family offices, correct me if I'm wrong, are looking for high-profile luxury hotels.
Not every family office is the same, right? So if it's if it's an Asian family office and they want to buy it at a 2 cap, yeah, that's an entirely different profile of an investor because they're looking to park money. They don't really care about the return, right? But if you're looking to do something where it's actually productive and they can actually use that to augment their society's foundations, then that's not going to be a good fit for them. But they want the same caliber, with the same caliber leadership, the same caliber family office going in. A lot of these family offices don't lever as much as like regular mom and pop investors because they have a lot of money. They don't have to use a lot of leverage, and they use real estate basically as a cash repository, right? So they're not going to be in trouble, but they're the ones who are smart enough to see opportunities down the line in the horizon. But beauty's in the eye of the beholder. If they want to buy the Waldorf Astoria, different capital sources have different needs and wants.
Yeah, if you want to extend that thought to sovereign wealth funds, obviously
Sure.
The Waldorf Astoria.
Yeah.
You've got the Sears Tower, or whatever they call it these days.
Those
In
are
Chicago was bought by the Korean pension fund. You've got, the Saudis own half of Piccadilly Circus in London. So yeah, absolutely right. You're looking.
Yeah, but
People
you
are
gotta have
looking
those
for
relationships,
Yeah.
and you gotta be trusted to write the check. And I've had people stand me up, and it's not fun.
Yeah, I do have a funny story. I had a guy who Sal knows who was well-known venture capitalist, and he was doing a deal. So he wrote a book, and I was publicizing his book, and somebody wrote to me and said, "You should never do business with this guy." I said, "Why is that?" Because 30 years ago, I was doing a deal with him, and we went into the office to sign papers, and he said, "I got to go to the bathroom." So he gets up, walks out, and he doesn't come back. So again, you have to know it's embarrassing, it's terrible when that happens, but Sal, again, these are, I don't know if you saw any of Jeff Hughes' presentation today or Ken Fryer's yesterday, but there's a lot of doom and gloom out there in the economy. Any thoughts on what family offices are they pulling back? Are they de-risking? Are they saying let's look at 5 different ways?
They're right now are anticipating what comes next. They're not really repositioning anything because they've done that already during the past credit cycle. So they pulled out a lot of their equity. We were beneficiaries of that, and now they're just sitting on it. And they're not that levered, so it's not like they're going to have a gun to their head or there's going to be any sort of technical default. But they're looking for the opportunities from the lowest common denominators who are beneficiaries of these low interest rates to start blowing up and going in and pouncing into real estate, into assets that they know.
Hard assets.
Yeah,
sure,
hard assets
sure.
they know. So if their office is office, if it's industrial, but they see a large 50-year-old industrial family leading it, then they'll go into industrial.
The biggest difference between 2008 and today is that in 2008 there was a mystery around hedge funds. People would say, "Well, I can't tell you; it's my secret sauce." Blah blah blah. And now, a great story I was told. I was sitting down with a family office 6 years ago. I said, "So, how's your golf game?" We don't golf anymore. So if I go to the golf course, it's 9 holes, never 18. But he's like, "Got this thing here, and it keeps me busy all the time." And, he's pointing to his cell phone, right? Because so people have become deeply analytical. And when they don't want to do it, they go to Eisner Amper. And I was hoping Natalie could talk a little bit about like the kind of services you guys offer to do analysis for these family businesses.
Yeah, we have outsourced family office cloud accounting, we have sophisticated audit, we have many different ways to augment family offices. In fact, when we talk about claims, quotes, etc., finding tax advantage ways to do that. And then we have our service line as well, which helps the family's communication, provision, and governance.
Right, and so I guess that you must also look at domicile of assets. If you're working on, planes and boats and things like that, because I think California has some punitive policies towards that.
Domicile of assets. There's honestly too many service lines to add, and we actually do have the largest set of sophisticated accountants, a team of over 40 that just specialize in family offices and high net worth families. to help understand theirs. Even the big four, although they're bigger than us, they have people who part-time do family office. So there are solutions, again, not in accounting, that I don't even know about, but I do know all my legacy family office clients that had before coming to here have been more than pleased because there's something that they can find, because this is what they do day in and day out.
And so besides your work that you do in the planning and business planning and business assessment, there's also a pretty broad group that also is involved with trust and estate planning, taxation, et cetera, correct?
That's correct, yes.
Fantastic. One more question.
Just about Eisner, do you do family office services also?
Talk about Eisner's Family Office Services. I think that Paul was going to talk about that, but you're welcome to talk about it as well, Natalie. Family Office
Yeah.
Services?
We do have family office services. Like I said, we have outsourced family office services where we can be your back office, and then we have the accountants who help the family offices directly. They act almost as a multi-family office for them.
Thank you.
Thanks. Perfect. Great. Any other questions from the audience? Fantastic. Listen, great job,
Thank
Sal.
you.
Thanks, Natalie. We're going to move over to the next group of speakers, and we have Eisner Amper talking about some of their services and about the current tax environment. And I think one of the big questions around today, as a lot of the people that were talking earlier, is that people are expecting a